Hey traders, welcome to Top Tier Outlook. Hope your weekend has been a great one, a relaxing one. And we like to prepare for the week on a Sunday evening. So let's get to it. A couple things on the radar before we get started. And it's all on the economic calendar. If you don't already get the Top Tier Outlook, check out Estimize, check out Forex Factory, Trading Economics, places like that, because the economic events that I am looking for have to do with high impact, what's going to affect the macroeconomic outlook, therefore, what we then, in many ways, presume the Federal Reserve will emphasize in their messaging and statements and in their different communications to us. And of course, earnings, we're still in earnings season. So it's not that every single earnings release is important. It's that certain stocks are going to move sectors and the indices, and it all has to do with high concentration weighting. So what are those high concentration weighted names? That will be tail wags the dog events. And then ultimately for this week, while there are a number of economic events, remember that other central bank events aren't as important to the US markets as the US central bank. But second and third to that would likely be the European Central Bank, the Bank of Canada. Bank of England is this week. So these could be events to keep an eye on. They're going to hit the market mostly well before the bell, but definitely something if you'd like to keep an eye on. Can't hurt, but I don't think it's as much a market mover as, say, the ECB or even the Bank of Canada has been. So not as concerned about Bank of England or even Reserve Bank of Australia, but it's good to know they're there in case something unusual is mentioned in the statement or the press conference, which may have reverberations past that country's economic outlook and monetary policy. So a lot to look at, but at the end of the day, it's non-farm payroll, gang. This Friday is non-farm. And if this previous Friday was a confirmation of just the data, gang, right? The data says the Federal Reserve has a grip on inflation. It's the PCE. It's their preferred inflation gauge. It's the one that they use in their models. If that says what Powell said is on track, we are going to continue to expect a pause for 2023. Let's say the jobs number is much stronger than expected, so better than expected, higher than expected. That would possibly increase the possibility. I don't think it's going to become a probability, meaning what's the most likely versus what's possible. We already have a 1/4 point hike sort of lurking in the shadows on those target rate probabilities of the Fed fund futures, but do they start to get neck and neck with the pause? And at that point, we know we've got to be more serious about one more hike from the Federal Reserve. However, if inflation continues to cool and if jobs remain decent, not too good, but we probably can presume the pause. If jobs are slowing, right? If it looks like the Federal Reserve is hurting the economy, hurting jobs, if unemployment is ticking up, if those are the situations, then we're going to stay with the pause, right? And the Federal Reserve is not going to hike again. One quirky part of a 3-part non-farm payroll on Friday will be that average hourly wages. And that's kind of in an unusual spot in terms of what the Federal Reserve would like. So I would say, rather than saying, Rog, how do we know if something's good or bad? Here's the punchline. Just watch the data at 8:30 on Friday. But that's the big hot zone for this week amongst a number of high impact stock releases. So we have this earnings window, and then we have this macroeconomic. Okay, that's the week in terms of what those volatility events could be. What of the trends? What about those things? Well, first of all, gang, it's a really big deal that certain stocks and certain sectors have made a move. Now, if you've been following me for any length of time, either at Charts and Coffee or here in Top Tier or even the newsletter, or most especially my mastery, you know that we do not believe in sort of this traditional concept of market breadth. It's very misplaced. And I'll tell you why before anybody says, oh my gosh, here goes Raghee doing her heretic thing. No. We always want to question the dogma of the market, right? So if we ask ourselves, what is market breadth? It's wider participation of stocks. And Raghee, why would not be a good thing to track? Because all stocks don't matter. And I think we know this. Certain stocks matter. And it's actually a very small list. And why is this? Because of high concentration weighting. Gang, I can say with a lot of confidence, it's far less than about 100 stocks that move the broader markets, S&P, Dow, NASDAQ, Russell. It's less than 100 stocks. Why is that? Because a very few number of stocks move the sectors, and those sectors move the indices. That's why it's so important to watch earnings during this time of year, because even one stock that's maybe top 10, top 5 weighted, right, which is already a pretty good weighting, with a disproportionate price move can make a big move, impact an index. It can impact a sector. So we have to be respectful of that. But does it matter that all healthcare stocks are moving higher? Not really. Does it matter that United Health and Johnson & Johnson were able to buoy above their 200 propulsion? Here's why. These are the number 1 and number 2 weighted stocks in the XLV, and the XLV is the number 3 weighted sector in the S&P and the Dow. That's how important specificity is. Market breadth is the opposite of specificity. It's looking at all the things, right? What we know in this environment is certain things matter. Identify those, you know where everything else is likely to go. That's why for the first time in a really long time, we can see that the S&P and the Dow are not reliant on tech to keep moving higher. This is great news. This is market breadth, if you want to call it that, that matters. This is participation that matters, because now we're seeing the main sectors of the indices all starting to fire. XLF, XLV joined the party for the host of tech sectors and consumer discretionary that's been powering the NASDAQ higher, and taking the S&P and slightly grudgingly the Dow with it. But as soon as financials and healthcare get going, now we've pretty much got those 3 important sectors in play. And you might say, Rob, you're talking about healthcare and tech and financials for the Dow. Well, the reason is really simple. Transports and industrials are no longer top 3 weighted sectors. The Dow Industrial Average might as well be called the Dow Financial Average, because XLF is the number 1 weighted sector in the Dow. But since IYT and XLI are already moving higher, the gang's all here, gang. So this is actually this last week, and really so far July has been a very important month. And if that transition from Q2 to Q3 is telling us anything, gang, it's wider, more important risk appetite. So punchline, I am not a bear, right? We've got to buy dips. We've got to focus on the long side, because we're seeing more and more key sectors participating to the upside. So this is very exciting. A lot of our sector folks are saying, Rog, how come all of a sudden it seems it's easier to swing trade? How come all of a sudden it seems the follow through is better? This is why. When we have the Dow moving higher on all 5 of its cylinders, if you will, you can add transports and industrials in there, but primarily financials, tech, healthcare. Why do we see better follow through in the S&P? Tech, financials, healthcare, right? So when we see that kind of movement, it's very tough to be bearish. It's much clearer to buy the dip. And because the overall movement is much more clear and wide, right? It's more participation from those key places. The follow through is better, right? So it's not just an uptrend. I hope you're getting where we're going to with this. It's which sectors and stocks are in an uptrend. So very, very exciting times. And by the way, speaking of exciting times, really briefly, I know I've talked about it. I want to make sure everybody knows that on August 2nd, this Wednesday, gang, in just about 3 days, 8 p.m. Eastern, New York time, we're going to be having a webinar. I'm going to be walking you through a number of setups, but with specific explanation on what we've been focusing on in the Sector Secrets Mastery this month. So does it matter what we've been doing the last 12 months? I mean, I'll talk about some longer term positions we've put on. Our overall portfolio for longer term has been very strong. Our day trading is going well. But I think the most important thing I can share with you all as we're here in the middle of summer is how we've been doing the last 3 weeks, 4 weeks. And I'm going to go through the good, bad, and everything. Actually, there's been very little poor in July because we're seeing better structure. But how are we staying on top of it? Which symbols, which sectors are we focusing on? So I'll be sharing all those trades from the mastery. And that's something I want to definitely emphasize. These are not trade examples that we have not taken, right? These are all Sector Secrets Mastery examples that we're going to go through in this webinar. You can register over at simplertrading.com/opportunity. If you've been wanting to kick the tires on the Sector Secrets Mastery, the alerts, the layout that I share with members, and we've actually never done this, and current members will get to benefit from this as well. I never want to neglect my VIPs that have already been members. Everyone gets 30 days to try the HPMRs and the DPMRs. So this is something we've never done before in terms of this trial package for the mastery. And you see right there, gang, it's $7. I'm kind of spoiling the surprise, but I want everyone to be able to focus on what we're going to talk about in terms of the charts. But I'm letting you know, as of August 3, the very next day, we're going to start this trial. It is limited time, gang. So this is not going to be something we're going to say, oh, we're going to do this again in October. Not going to happen. So please, 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 if you've been wanting to do something in terms of ratcheting up your studies and your approach for summer, or you've been wanting to check out what we do, please, gang, I would hate to say on September 2, that window's closed and it's done, and because it will be. All right. So August 3 to September 1, come join the immersion with us. And let's move on to some questions. Yeah. All right, let's do that. So let me bring the charts back up. There we go. Let's get to it. All right, first up is, hey there, Nick. The weekend is going well. My sister's in town visiting, so it's been great. And we're going to watch, I think we're going to sit here in the office and watch a movie together. I'll probably work a little bit on the newsletter as well. So it's been a great weekend. Thank you, Nick. Hope yours is awesome as well. Which reports or events are usually more impactful on the direction of the euro US dollar? Okay, so obviously, let's get the two out of the way that are clear. ECB, FOMC, which I know you know, right? So let's move those aside. Anything that's going to affect the overall messaging and monetary policy is going to be impactful. So think which hot zones would be jobs related. We've got the jolts this week. We've got unemployment claims, non-farm, big week for the jobs macroeconomic basket, right? If you think about macroeconomics as three pillars, right? Jobs would be one of them. In fact, the U.S. central bank, the FOMC, is the only major central bank that has a dual mandate of not only inflation, but also employment. So anything that has to do with jobs, growth or contraction, and then growth itself, growth of the economy, GDP, which frankly is the least important right now, because we could argue that there was already a recession, 2 negative GDP consecutive quarters, and the Federal Reserve blew it off. So what is recession anymore? It's anyone's guess. So actually, of all the macroeconomic pillars, I'm ignoring GDP. You'll notice it hasn't been a market mover either, because no one knows what a recession is anymore, right? So the most important two are going to be jobs and inflation. So those PCE and CPI numbers primarily, but then a number of those other releases like the PMI numbers, of which we have this week too. So anything that's going to affect whether or not the ECB could hike or cut rates affects the euro, which affects the US dollar, and then anything the US central bank is going to communicate or have to respond to regarding whether or not we're going to pause or eventually cut, because that's the direction we're heading. That would be what to keep an eye on. All right. So thanks, Nick. Glenn asked, based on Wyckoff's system, how can we tell the SPX is in distribution or accumulation? What clues can we tell from price action or volume? Glenn, I am far more a Dow fan than Wyckoff. Wyckoff really built a lot of what Wyckoff approach is, or Wyckoff approach is, from Dow. I respect both, but I'm much more a Dow person. But frankly, I don't know. I don't study the system well enough to say I've decoded and codified it, right? Because if you look at both Charles Dow and Richard Wyckoff's approach, there's a lot of subjectivity to describe what they're talking about. We could talk about throwbacks and accumulation and springs and breakouts and reaccumulation. And I'm trying to think of all the lingo in both their descriptions, right? But I think the main thing to remember, Glenn, is that again, I'm going to say that Dow is sort of the foundation of all the different types of variations, including wick-offs. Remember, they use volume. One of the key things that Dow talked about was volume, and there's no volume in SPX. So I wouldn't even begin to look at SPX through Dow or Wyckoff's approach. I would focus on the ES future. So that's number one, because if I'm going to look at accumulation distribution, if you study Dow's work, which definitely impacted the latter, to your question, you got to put volume into the conversation. So ES over SPX. And then to codify it, I don't think anyone's really codified either one of their definitions of accumulation distribution, markup, markdown. Therefore, early on in my career, I decided that I was going to use exponential moving averages to do it, because while we could look for certain characteristics, I found all the descriptions were quite not bad. They were just very subjective. All right. So with that in mind, to remove the subjectivity, what I did is I created the wave and grab candles. And then eventually we have this multi-trend here at the very bottom of the screen, which used the moving averages and their relationship to each other that I used to define what accumulation, markup, markdown distribution is, add in volume, and that's all you really need. So I can't specifically talk to that particular system, but I can say you got to use volume, therefore ES over SPX, and then some simple moving averages I have found over the past 30 years have decoded that. But thanks for the question. I'm a huge fan of classic, old school, time-tested approach. And of course, both Charles and Richard were on first name basis, right? Glenn, both Charles and Richard did an outstanding job of, I think, creating a foundation upon which modern day traders can use that kind of older wisdom to do things that a lot of traders overlook. So kudos for the question. Thank you for asking. All right. Let's see. Next up is question from Jay. All right. Hi, not in Pat. Hang on. Let me read this first, Jay. What's my opinion for a long on EFX? All right. So let's see. Part. It's not in part of a heavy-weighted sector, but what's my opinion of EFX? This one's tricky. It's oversold. Slow stochastic neutral environment, the trend that preceded, kind of going back to the earlier question that Glenn had regarding market trends. Trend preceded the chop was up. So this is a bullish chop. I would say let's wait for some of this zone here, double Darvis. Yeah, we have a lot of Darvis zones starting at about 196.5. There's another one at 203.06. How about a minor low, which we have in the process right now? So my opinion for a long would be tomorrow specifically. It has to happen tomorrow. Jay, we need to break above 206. 206. Thanks for the question. All right. Next up, do I see Dell continuing its climb? Do I see Dell continuing its climb? I would wait for a minor low here as well. The overall trend is up. Let's look at it from another perspective. I'm going to pull it up from the perspective of my grab and wave tools, and let's see if we have any kind of reversion to the mean, which I do believe we have on Dell. Yeah, here you go. So there's a reversion to the 34 EMA wave. It's a slightly larger candle than, say, the last 5 to 7 that preceded it. So a minor low would make sense. And so I would say yes, but I need to see confirmation by way of either an inside candle, also known as a harami, or a minor low pattern, preferably one that remains within the zone of the 34 EMA high to the 34 EMA low. So yeah, I would say that's what I would focus on there. All right. Next up is And you know what? Let me show you another way to look at this one. Because Dell and some of these pullbacks. Yeah, here's another thing I was looking at, but we didn't stop there. I was looking at this tiny little gap, right? You see that, which we closed on the 10th. So we had a gap from between the 29th, right, and the 30th, 29th and 30th. And then we closed it on the 10th. Yeah. We didn't stop there though, did we? There we go. Yeah, we didn't stop there. So that's another thing I was looking at there, just in case. And probably the only other nuance I'd say is be careful, because while I would still remain bullish, my level of bullishness is going to be largely dependent upon that lower row of colors, which is called the multi-trend, which, by the way, when you join even the $7 trial gang, there is a specific layout of a number of tools that are specific to the Sector Secrets Mastery that you get with the trial. So that is one of them. When folks ask, Rog, what's some of the most important data on a chart for you to make a decision? It's the multi-trend, gang. That's what a needle mover it is. If that thing confirms yellow, I'll have to wait for an oversold stochastic. I'll probably be much more conservative about the entries. All right. I'll probably be much more conservative about those entries. And while we're talking about Dell, let's dive into a little bit of NASDAQ and semiconductors just for a moment. So when we talk about mean reversions, they're not always going to happen. The NASDAQ is a great example of an overall uptrend that tagged the 21 even rarely. So if you're waiting for a mean reversion to the 34 EMA wave, which is what I teach, or maybe something more aggressive, like the green dots of the propulsion, notice that within the context of these uptrends we're seeing in the broader averages, we haven't seen a lot of this. And you might say, well, yeah, Rog, what do you do when that happens? Well, let's take a look at the NASDAQ with another set of tools on here. And this is the daily price movement range. Now, by the way, with the trial, you will have 30 days of access of the updated daily price movement range. The daily price movement range gets updated about every 3 weeks or so. And so you'll have basically a month's worth of update on DPMR. And I wanted everyone to be able to check it out, because it's really, at the moment, in an environment where we lack these mean reversions, we are pulling back to correcting to daily price movement ranges. So every time the candles sink into the gray area, ask yourself, can I buy? And just, if you're watching this on a recording, pause it for a moment and take a look. Since basically the end of April, the beginning of May, how many times in that green multi-trend environment, if you had the gray zone of the daily price movement range, which is the support zone, you could have bought it, right? Knowing that the structure is bullish and buy the dip is valid. So it's been very valuable. And then if you take a look at semiconductors, which is sort of the honorary fourth sector, right? After XLK, after XLC and XLY, we don't have that many visits. It's been a whole lot choppier, but ask yourself again, when that lower row is green and we are at the daily price movement range, or if nothing else, if you focused on the long side, even with the wave, right? See how rarely we touch the 21. Here, there was one opportunity on the 6, but anytime you have that green structure, buy the dip is going to work. And in an environment where we're not getting a lot of opportunities to buy the dip at a mean reversion, this is definitely something most traders won't see on their screen, because it's based on historical volatility, and it's something exclusive to what we do here at Simpler. All right. So that is SMH in the NASDAQ. Oh, you know what? I mentioned healthcare and financials earlier. Let me show you all a quick view of this. And if you have any questions, gang, type them on in. We're broadcasting across YouTube, Facebook, Twitter. So if you have a question, type it on in. Take a look at XLV. This is huge, gang. Like I mentioned, Johnson & Johnson and UNH got above their 200 propulsion. That's the 200 exponential, crossing with the 8 exponential. This is significant, because now we have, for the S&P and the Dow, all three main sectors in uptrends. And so take a look. Also, once we go green, is the daily price movement range in play? It is. And if you can wait for those green environments, and you're seeing They're one after the other after the other. They're overlapping, right? This is probably the best looking uptrending environment for equities and sectors and indices that we've seen in a very long time. Frankly, probably the best since 2021, before the conversation about rate hikes started being filtered into the market. It's a very good looking set of uptrends. And this is why the swings are working so well. And this is why I'm especially excited that we're going to be having the trial at a time where more and more sectors and stocks are beginning to turn into uptrends. So if I've got JP Morgan in alignment with XLF, if I've got Bank of America in alignment with XLF, my Russell traders, it's not just the big banks that are organizing into an uptrend. Even the absolutely smashed earlier this year, KRE, is not only going into an uptrend, but trying to break the 200. So again, these are huge potential moves that are signaling that if we are willing to be patient, wait for that zone to get long and buy the dip, we're going to be rewarded. KRE is just going to continue to contribute to the buy the dip that's been working pretty darn well in RTY. And by the way, this could be DIA, SPY, QQQ, IWM, right? But when these key sectors, so for Russell, it's regional banks, when these key sectors are moving like this, gosh, I know this is the most bearish I've heard everyone talk about. Oh, we're too far and it's too much and it's too extended. Gang, so is 2020, right? It's monetary policy that dictates what is too far. And if we're going into a pause, and that's a big if, because I can't see into the future, but and newsflash, nobody can. But if this is the process within which we go into the pause, before we start to cut, we get the pause first. So pause is sort of the on-ramp to the highway of cuts. We know what happens when central banks become accommodative, right? All right, a few more questions popping in. And Deborah asked, do I buy the dip on the HPMR on the daily? No, Deborah, thank you for that question. I will use the hourly price movement range, the HPMR. And by the way, for those of you saying, Rog, I missed the opportunities before to get the HPMRs. During the trial, you will get the updates. So you've got a fresh set of HPMRs and a fresh set of DPMRs between August 3 and September 1. So we'll make sure you got the fresh ones. Remember, after September 1, the accuracy starts to degrade, right? Because the volatility data must be updated incrementally. However, you'll have some really great ones. Okay, so that said, the question about HPMRs and DPMRs. So on the intraday time frames, no greater than a 1 hour, and really for me, no greater than a 30-minute, the hourly price movement ranges are what I use. So can you buy the dips on HPMRs? On time frames, basically 30 minutes and less, that's fine. On longer term, 60 minutes or greater, that's where I use the DPMRs. So can you buy the dip on HPMRs? No, not on daily time frames. They're studying hourly volatility ranges, and that's just too it's too little a data. It's too little in terms of, look, if I'm looking back at the volatility of 9 to 10 a.m. on a Tuesday, 10 to 11 on a Tuesday, right? We're looking at the Tuesday or Monday, whatever you have it. If we're looking at the hourly chunks, but I'm looking at a time frame that's as big as a daily, too aggressive. But when I'm looking at a daily, I want to know what the volatility range was on a Monday. What was it on a Tuesday? What was it on a Wednesday? So they do match up to a specific time frame with that logic that if I want to take advantage of a longer term trend or a pullback to a key level, that on the daily or even anything greater than the 60, it's got to be a DPMR. And that's why we have DPMRs and HPMRs. Yeah, so I hope that makes sense. I may not have explained that awesomely, but Deborah, the simple answer is no, but that's why. So can you use other time charts for other conditions? DPMRs, 60 minutes and greater. So that means anything less than 60, HPMRs. That's probably the easiest way to sort of divvy that up. So thank you for the question. What are my thoughts on footprint charts versus volume profile? Glenn, I'll be frank. I don't know what a footprint chart is. I've been trading a long, long time, but I by no means am I a dictionary encyclopedia of trading. I don't feel we have to be, but I'm not familiar with those at all. I'm a fan of volume profile, though. I'm a big fan of volume profile. And that's what I do use, price-based volume. So if there are other ways to do it, and again, I don't know what a footprint chart is, but if you can find how much volume happened at a specific price, right? Whether that be VWAP, V profile, your value area high, value area low, point of control, V score, which is an indicator I created. If you can do that, however, whatever the style is, cool. Yeah, cool. Let's see. Furman asks, will the indicators in the trial work on TradingView? Bot, yeah, TradingView for the month. We'll be activating folks on TradingView as well. So yes, if you use TradingView and you're going to come join us for the trial month, yes, it's tossed for sure. And I do believe TradingView as well, but I'm going to wait for confirmation from the bot. And I do not know though. Yeah, so the simple answer is yes, Furman. Once you have joined, we'll give you the instructions on how to do it. All right. Yeah. So the simple answer is yes. All right. Let's see what else we have here. Oh gosh, we're out of time. Sorry, gang, I've been running over. Sorry. All right, I got a movie date with my sister coming up. Gang, I'll see you tomorrow. For our charts and coffee. If you have any questions that I might have missed, feel free to ask them tomorrow. I'll be here at 9 a.m. for our 20-minute show. And so, yes, we will have TradingView. Yeah, Furman, TradingView and Think or Swim. Yes, we will have the free indicators, the included indicators for the trial package then. And again, webinar on Wednesday, simplertrading.com/opportunity. Be good to each other, gang. I'll see you tomorrow.